Well, it's a great pleasure to welcome Eric Sprott, who's the founder of Sprott Asset Management, to Business at Night. Good evening, Eric. How are you?
Hey, John. Great to be with you again.
Well, it appears that the secular bull market in gold is back on the track.
It would certainly seem that way. There's all sorts of indicators of that. Probably the most obvious one is the gold stocks are up something like 67% since January 19th this year. Price of gold is up almost $200. There's a lot of money pouring into the physical gold ETFs. We've had a number of major commercial banks, amongst the big 10 in the world, sort of changing their tune on gold, where various, the technical analysts or the gold analyst is suggesting we might see a lot of things changing. And, of course, we have lots of economic things, whether it's the economy going down, the zero interest rates, negative interest rates, the suggestion that people shouldn't be allowed to have cash, all of which are making people think more clearly about where everything's headed.
Now, what are the ramifications of the central bank's dangerous negative interest rate experiment?
Well, John, it's interesting. You can see, for example, I saw a data point out of Japan that you can't buy a safe anymore, to store gold in your house because they're all sold. I hear that the demand for, I think it's 10,000 yen notes has gone off the end. Everyone's buying their notes to take the money out of the bank. You store it somewhere at home. I mean, the obvious thing is if you really have negative interest rates, so you leave your money in a bank, which is a highly levered financial institution, and you're just an unsecured creditor, and they say at the end of the year that, the $10,000 you have in there is worth less than $10,000 at the end of the year. Well, why would you leave it in there when you're taking all that risk? So people obviously should take their money out of the bank. There's no sense taking on the risk of the bank. It's a very levered financial institution. And, of course, the next thing you wonder about is, well, is it better to own the paper or the gold? And, of course, you and I would both agree it's always been better to own the physical asset rather than the paper asset. So I think it brings people into the precious metals markets for certain with negative interest rates.
Is the well-advertised recovery in the U.S. economy since 2008 just a mirage?
Well, John, I happen to think it's bogus. And whether you look at housing starts or, Caterpillar sales that have gone down for 34 months, or like Class 8 truck sales were down 58% last month. The consumer confidence is plunging. The ISM service index is in contraction mode. I mean, there's so many data points throughout the world. Probably the most notable one, though, is when you go to Japan and South Korea and China, you look at the export and import numbers. I mean, they're all down double digits. And that's not just a little recession, by the way. That might be qualified as a depression. So I think all of what's been done here over the last decade, I'll refer mostly to the U.S., but, subsequent to the NASDAQ crash and the financial crisis in 2008, the powers that be have done everything they can do to try to sustain the economy, and they sustain it by these zero interest rates, which lets people buy houses who can't afford houses, much as they did in 07, 08, lets people buy cars who can't afford to buy cars. So you bring all this consumption forward, and you still bumble along at 1% to 2% growth. We've run out of arrows here now. We can't reduce rates anymore. We can't bring any more people in. The debts of all countries have exploded here. So, yeah, they've kind of held it together. But as you know, in the Austrian school, when you create economic growth by creating debt, someday the debt has to shrink because you have to service the debt. And I think it's all been a mirage. You look at some of the earnings releases and the outlooks of the various CEOs in various industries, the oil crash, the non-precious metals crash. It all leads to one thing, and that is problems down the line here. So I've never been a believer in most of the government data. I don't believe that the unemployment rates are really 4.9%. I think that many people have had to take multiple jobs now because most companies only want to hire you for 29 and a half weeks. So you get a guy taking two jobs. It sounds like we created a job, but it's a lousy job, and the good jobs are disappearing. So no, I've never been a believer in the whole monetary policy that thinks they can cause the economy to strengthen when it's really been weak for a long time and now probably going negative.
Has global banking become the biggest Ponzi scheme, i.e., if depositors want their money back all at once from banks like Deutsche Bank, they may be in for a Lehman surprise?
Well, of course, the problem with the whole banking system is, they borrow short, and borrowing short means you have a depositor who thinks he can get his money out the next day, but you're lending long. You're lending against a house mortgage that lasts for 30 years or a car loan that lasts for 7 or 8 years now, and the depositor says, I'd like to get my money out. Well, now you got to sell an asset in order to get the cash to pay the depositor back, except there's no market for the asset. And or you'll knock the price of the assets down. You get to sell stocks or bonds, or tell a guy, you want his mortgage paid, he's got to sell his house. So the fact that these institutions are so levered, they borrow so short and lend so long, it just creates a whole problem that we had in 07, 08, when I would remind all your listeners, all the banks were effectively broke. And people should realize that. They were broke in 07, 08. They were bailed out by the various governments. But the reality is when you're levered 20 to 1 or 30 to 1, it doesn't take much of a decline in the left-hand side of your balance sheet, the asset side. If you lose 3 to 5%, you have no capital. And I think we're seeing signs of that stress when you look at what some of these bank stocks have done, Deutsche Bank being the poster boy these days. But even the banks, I think RBS came out, Royal Bank of Scotland came out today, reported a loss. Standard Chartered had a loss. It was one other major loss of the European bank. HSBC, I think it was, yeah. They're having trouble putting it together. Of course, negative interest rates, the spread of the bank are going down. Earnings are going to go down. JP Morgan just announced their trading revenues in the first quarter down 25%. So these banks are very, very risky. I've always believed that. And when people start worrying about having money in banks, that's when gold and silver get going.
Has the $1 quadrillion derivatives monster magically gone away?
Well, I just find it totally ridiculous that they have all these derivatives, and the funny part is most of the derivatives are held by 4 institutions who just seem to trade with themselves. For what purpose, I have no idea. But no, it hasn't gone away. When you think of a quadrillion, which is a pretty big number to think about, John, it doesn't take much of a decline on a quadrillion. The bank capital in the world might be, I don't even know if it's $2 trillion. So, you get a 2% decline in assets underlying the derivatives, and all the bank capital is wiped out in a day. And we've seen such volatility in currencies and stock markets and bonds, whether, you might be short government bonds, you're getting wiped out. You might be long triple Cs, you're getting wiped out. There's so much volatility out there that to imagine that these derivatives haven't suffered losses. Somebody's suffering losses here. And, of course, what happens is the guy with the loss can't pay. And so the guy who thinks he's got the gain is not going to receive it because the losses become staggering. And, of course, again, the poster boy is Deutsche Bank, that I think has something like 60 to 70 trillion of derivatives. And I think their shareholders' equity is something like 300 billion. So, and I might have overstated that a lot. It could be as little as 60 billion. So it just takes nothing to wipe them out.
Eric, we're going to break for a moment and come back and continue this conversation. So, folks, stay with us. You're listening to 580 CFRA. I'm back with Eric Sprott, the founder of Sprott Asset Management. And, Eric, what do you think about the fact that gold is the most hated and under-owned institutional asset, and what does it mean for the price of gold when institutions get the bug?
Well, everybody badmouths gold. In fact, I was shocked to see some economists from the Chicago Mercantile Exchange coming out and saying how gold would go down. First of all, they didn't even know they had an economist, let alone I've never heard any opinion on anything. And now it comes out and opines on gold. Of course, the gold at the commodity exchange, it's a de minimis amount now. I think it's like maybe 8 or 9 tons of gold, which is a joke in terms of value. But everybody badmouths it because it's the canary in the coal mine. You and I have talked about this before. The central banks don't want gold and silver going up when they're obviously have ridiculous financial policies of printing money and zero interest rates and now negative interest rates. Gold tells everyone that there's something wrong with the system. We all know inherently there's something wrong with the system, that you should have zero or negative interest rates. That's the one thing I'm sure your listeners would appreciate. This is all abnormal. We're just trying to hold it together here. And they've sort of held it together, but I'm sure lots is going on behind the scenes. And obviously the demand for gold has picked up here. The ETFs, I think for February, they've already picked up 160 tons. Well, just to let your listeners know what the significance of that is, the mines ex-China, ex-Russia produce 220 tons a month. Well, you can't have the ETFs buying all of that output because there's lots of other buyers. And when I look at the annualized rate of change in ETFs last year, they lost 138 tons. This year, it looks like at a rate of, let's say, 100 tons a month, they'd pick up 1,200. So we have a delta of 1,300 tons in a 4,000-ton market, which was in balance last year. So I think, everyone is trying to get through this small door. And the small door is it's tough to buy gold when everyone goes there. The world gold supply increases by 1.5% a year. 1.5%. How does somebody go from owning 1% gold to 2% gold? That would necessitate a 100% increase in gold supply. But we only get 1.5% a year. So, the price of gold has to go up and the mining shares have to go up for people to be able to deploy money in that area. And I think that's exactly what we're seeing. Everyone's trying to rush through the same small door. But believe me, it's a very, very small door. And, in fact, the door into silver is by far the smallest. And if people, for example, they put $80 billion into gold so far this month in the ETF. I mean, you couldn't possibly put that into silver. There's something like $400 million worth of silver sitting at the COMEX. So how would you fit any part of $8 billion into that? I mean, it's just ridiculous. So things have changed. There's been a sea change here. We have a lot of bear markets in stocks around. Of course, we get bear markets in all bond markets, save treasuries. So it's a very difficult environment for people. You and I have spoken about it many times. I've always believed that gold is the place to be. I'm reminded of the movie The Big Short when those guys had it all figured out, as I did at that time, that housing was a sham. And, they took it so long for them to make it right because everyone was working against them. Everyone lied about the housing subprimes contained. Ben Bernanke, subprimes contained. Well, it was certainly not contained. And all those pundits who say, you shouldn't own gold, they're talking their book here. And I would encourage your listeners to certainly maintain and increase their positions in the precious metals.
Now, during our careers, we've seen outrageous manipulation of gold bullion prices because gold is the historical real money enemy of central bankers who have bastardized their currencies through excessive printing, otherwise dubbed as quantitative easing.
And you see it all the time. We saw the Chicago Mercantile Exchange today raise margins on gold. It's the second time this month. We see the short positions that the commercial bankers have taken on the CME. They're short 800 million ounces of silver. I think they're short, about 11 million ounces of gold. I mean, these are huge short positions that they've used to keep the paper price of gold and silver down. And just imagine if silver went up $1, those commercials lose $800 million. This is not pocket change anymore. And they've got themselves in a very difficult position here with their shorting of the paper markets. And I hope the day is arriving soon, and certainly the ETF balances are suggesting that you're going to have a shortage of physical gold and ultimately physical silver.
Now, to conclude, in this surreal competitive valuation world, how do investors protect their capital and ensure their purchasing power, i.e., what kind of survival equipment do you hold in your portfolio?
Well, John, I've mentioned many times before, I'm just a huge investor in gold. Like I probably have 60 or 70 or 80% of my money in gold. I've always believed it will work. You look at the data sets every day, and it tells you that gold is massively undervalued. I believe there's been more demand than supply for the last 15 years. And, of course, demand this year looks like it's going to just blow off the charts here. So I just a great believer you got to own physical gold or a physical like the gold situation where you can get the gold. For example, I trust you can actually redeem them and get the gold and silver. I've obviously speculated on mining stocks here. As I mentioned, they're up 67% in the last 5 weeks. I think we have lots more to go here. I think gold can hit a new high this year with the kind of trends we see. So I think there's a lot more on the table here in the precious metals market. Particular stocks could go absolutely berserk if we hit new highs in gold and silver. So that's where I'm investing my money, and I'm patiently waiting it out, and had a great start to this year, and I just hope that it carries on.
Well, Eric, as always, it's a great pleasure to catch up, and thank you for your valuable insights.